jobs this and jobs that. I don't give a damn about no jobs. People don't need no jobs. I'm gonna tell you what people need, huh? People need money. Lots and lots of money. That's why the only jobs I'm gonna create are gonna be down at the mint. That's right. We gonna print so much damn money, I'm gonna give every single American $1 million. Check it out. Ain't gonna be no more 1%ers. Everybody's gonna be million percenters. And then everybody gonna be rich. And nobody gonna have any more problems. And you ain't gotta worry about no damn health care or nothing. And then we gonna have a big ass party with all us millionaires.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a lot of red, down big today. The S&P 500 down 4% in 4 days, the fourth worst start to a September since 1928. Absolutely brutal week we've seen here, and September is living up to its name as the worst month in the year. We saw names like AVGO on their earnings down 10%. That brought all of semiconductors down too, and Nvidia down 4%, at one point hitting about the $100 mark. Absolutely crazy. We saw selling in technology, software, Apple, Microsoft, even here financials. Brutal day across the board. The only mildly green sectors was stuff like real estate, rate sensitive sectors, consumer defensives, certain components of healthcare. That was really it. The defensive sectors were kind of green, but today really felt like a liquidation. It was after those non-farms. Nobody wanted anything to do with equities. Buyers literally just walked away. The only green sector, or I should say flat sector, is real estate. They have it in the red right here. It should be in the white because it was just flat today. It returned nothing. Staples was in the red. Healthcare, utilities, the best performing sectors, they were down today as well. These defensive sectors. Tech, consumer discretionary communication services, Mag 7, growth sectors, they were down 2.6, 2.5, 2.1% respectively. And the broader cyclical parts of the market were down huge today. Look, financials, metals, energy, industrials, all down more than 1%, upward of 1.5%. Pretty brutal day across the factor and size spectrum. Large cap value, right, down 1%. This is the defensive component of the market. Same here with this mid cap section. They were the best performers. Growth got hit the worst, so too did small caps. Absolutely brutal day across the board. Pretty rough day for the equity markets if you ask me, and it all stemmed off the jobs report. We got the labor report, the US employment report, and it was not pretty. The market forecast was 161,000. It came in at 142,000. Both were expecting 200k in their forecast, so a huge miss here. However, the unemployment rate did fall by 4.2%. Hourly wages did also increase ever so slightly. That was a positive, and then year-over-year wages also increased, contributing to wage inflation, but nothing to worry about. This was what the market really looked at, and the US just added less jobs in aggregate. We also saw some pretty ugly revisions, and that is what really saw a capitulation here in equities. You see, we did trend down for most of the week, but we actually saw a capitulation move to the downside here in all of the major indices, and a capitulation move up here in bonds. TLT up 2% for the week. The major indices were down anywhere from 2.5% to 5% in something like the Nasdaq 100. So a pretty ugly week, and we really did see that. If you dive into the sectors under the hood, we saw the best performing sectors was just defensives, real estate, staples, utilities, and in fact utilities was actually negative here for the week, and then everything else had a pretty brutal sell down, with healthcare, which is also a defensive sector, but there's a lot of growth components in healthcare. XLV down 1.93%. Technology down 6% for the week. Brutal action across the market. But let's dive into the S&P 500 on a more granular level today. And the S&P 500 kind of looks really ugly right now. We're also in the RSI. We're below the 50 line, which means we probably target this overbought territory, this 30 level in the RSI, which probably means more downside here for the S&P 500. Guys, that is a very ugly candle after non-farms. We got the bad economic data that we wanted in negative gamma. Bad things are going to happen. And we actually did end the day / found a little bit of buying towards the end of the day here at the put support. Now, the gamma flip at 5,500, the put support at 5,400, 5,600 is the call resistance. I think this is going to move down next week. No, I guarantee you it's going to move down into Monday, into Tuesday next week. And we're going to see where the put support repositions itself. And that will probably be our next zone. We'll see if a little bit of a dead cat bounce comes here, but what an ugly week for the S&P 500. Terrible week when you look at the weekly chart. Let's actually go to the US 500. You can see, yeah, look, on the weekly chart, that's an ugly candle. That's a really ugly candle. We also did go ahead and make a lower high relative to this wick. It doesn't matter because we did go make a closing high right here. The closes are what really matters. So many people saying it's a double top. Don't listen to chart patterns. Chart patterns simply do not work. Just look at support, resistance, higher highs, higher lows, the options market. That's really it. Everything else you should determine from the fundamental picture and the macro. Chart patterns don't work in my personal opinion. But when we do look at this in aggregate, we've had a stellar rally. The fundamental picture is good. Earnings have come in good. It just depends how the material weakness we're seeing in the data is going to affect earnings. I do think we're going to see earnings pull back in the third and fourth quarter, but I think they're still going to remain robust. That's why I am buying the dip. I don't see a recession. Rate cuts are coming. That is going to be good for equities, but that's, 3 months, 6 months down the track. In the year and now, things are looking ugly. And I would say that this right now is a weekly line in the sand, this level right here. The reason why it's so key, we had this massive pullback right here. This was off the early August lows. Then we had a bit of tumultuous action at this section right here in May. And it's where we had a little bit of sell side here in March. We pulled back and then we sprang all the way up. So this is a very key level, the 52.87 level. I think next week, if we do pull back, this is probably where we find support. But on the weekly time frame, if we start breaking this level right here, things can get really, really ugly for the markets. Because realistically, when it comes to like a real solid bottom that we could find in the S&P 500, it's probably back to the 49.80, maybe the 5,000 level. So yeah, right here, this is the next zone if we do go ahead and break the 52.87 level. The risk is to the downside right now. We're clearly in negative gamma across all of the indices. And so next week, guys, the 52.87 is the weekly zone you want to look at. If we find support right here, that is constructive. But if we go ahead and break, yeah, that's not looking good at all. Looking at the monthly chart, I know the month just started. Things looking very constructive on the monthly chart. Nothing too crazy to worry about. In my personal opinion, really things are starting to unravel on the weekly chart as well as the daily chart. On the daily chart, if we go ahead and break this level right here, things get ugly. This is the weekly zone right here. So it's sort of like in this area that things really start to get ugly for equities. If we like pull back, have some support right here and then move lower, it's not going to look good. And that's when you start targeting lower levels. When downside flows and bad economics starts materially affecting the market, sentiment can turn very, very quickly and things can get ugly very, very quickly. And that is why you do want to trust the process. All in all, things have not broken down just yet. Yes, this is some very ugly price action, but that tends to happen when we get sell side. Price action looks very, very ugly until we actually start breaking these key levels in the S&P 500 as well as the other indices. That's when we can really start to get worried. Now we are getting the macro data that's not really supporting the case, at least not in the employment data. That's why the Fed is cutting rates. And so the macro, there's still that support right there. The Fed have a lot of room to cut. I think the fundamental picture is sound. Earnings have come in good. And yes, we do expect earnings to get revised, but that normally happens. About 7 to 8% worth of earnings revisions tend to happen leading up into earnings. So macro in the fundamental picture is still holding in there. It's just a technical picture right now that's not looking that great, and we are in a seasonally weak period. Now, the Nasdaq 100 probably is the ugliest chart out of all of them. It's actually pared back about half of the rally it saw here from the October lows, and it's getting devilishly close to breaking these lows, and then things can really start looking for the Nasdaq. This is clearly a lower high in the Nasdaq 100, whereas the S&P 500, many people say double top, but it actually looks like an equal high double top if you do want to look at chart patterns. The IWM looking very much similar to the Nasdaq 100, not looking constructive at all. And then the RSP, again, the best looking chart because we actually haven't made a lower high. This is a higher high, a new all-time high. And you know, the RSP just looks like it's in a typical pullback after making all-time highs. And as long as we hold this 162 level, I think the RSP, the equal weight, looks very, very constructive. Today's price action in the markets was supported by the dollar actually rising, the 10-year yield, the 20-year yield, and the 30-year yield all falling. The 30-year yield was actually flat, and we did see a pullback in Bitcoin, gold, and silver. Guys, really just a pull, really just a liquidation out of assets going into the dollar, going into cash with volatility rising. That's the price action we saw today, and that's the price action we saw for the entire week this week. So next week, guys, the plan is very, very simple. Expect further downside with our target being the 52.87. I think we're actually going to see a pullback in the put support to about the 5300 area. So there's a lot of confluence right here if the put support does move to this 5300 area with this highs right here, this price action, and the lows we saw here in October. So this 5300 area going to be very, very key next week. That is our downside target in the 5300 area. Now, I'm not saying take shorts. I actually am buying on the way down. I am bullish. I do think we're going to go higher into the end of the year. It looks scary now, I know, but that is what I believe is going to happen. And that's what the data is telling me. Until the data materially shifts, especially on the fundamental side, that's when I'll change my stance. But as it is right now, I do think we're going to go higher into the end of the year, into Q1 2025. And you do want to buy this dip. I repeat, you do want to buy this dip, but I do think we're going lower. So this is a period where you want to stack your cash and buy at strategic places. Now, what exactly do you want to buy? You want to buy stocks that are buying back a lot of their shares, especially as we do pull back, as well as rate sensitive stocks. These are undervalued stocks with significant buybacks that offer a great margin of safety, in my opinion. MGM Resorts, they're decreasing their shares outstanding by about 13% this year. They have a 10% free cash flow yield, highly rate sensitive stock. Okay, the balance sheet, not that great, but I do think in all of this, they should come out and rally once we do find a low. Another company is PayPal, free cash flow yield of 9%, decreasing their shares by about 5.5%. This number is actually now closer to 7%. I do believe this stat was a bit outdated. Bookings Holding, free cash flow yield of 5%, decreasing their shares outstanding by 8.5%. And I do have another stock here, Ulta Beauty, but I wouldn't buy it just yet. I would wait till the next quarter. So the three stocks, if you are looking to take buys over the next couple months, these are stocks I'm looking at: Bookings Holding, PayPal, and MGM Resorts. And something that's completely flown under the radar is what's actually happened with the yields. It's actually been drowned out through all the noise, but we have actually seen the 2-year yield and 10-year yield almost uninvert, and yields across the curve from the 2-year all the way to the 30-year are hitting 52-week lows. And when yields hit lows, it typically leads to above average returns in the S&P 500. You can see that the 2-year, 5-year, 10-year yield went at 52-week lows. 1 year later, you can see returns of 12.2% versus 10% in all other periods. And this is reverberated across the yield spectrum in the 10-year alone, the 5-year, and the 2-year. And you can see substantially outsized returns. And that is why the dip we do get in the markets right now, you do want to take advantage of that. And through all of this, how you want to be positioned is in quality, large cap quality, small cap quality, as well as rate sensitive sectors. And tech stocks have been on fire recently, especially Nvidia, after it saw its revenue more than double to 30 billion, up 122% in the last year. Tech has driven the majority of earnings growth growth, mostly driven by AI or the buzz around AI. And these companies are actually showing significantly stronger earnings growth than anyone expected in 2022 as well as 2023. And with tech stocks dominating, it's easy to see why the S&P 500 has been performing so well, up about 16% for the year. Despite all the volatility we're seeing, when the S&P 500 is up 16% for the year, you do know that the majority of investors are sitting really pretty on some very nice gains. And some say tech stocks are undervalued thanks to strong earnings. Others say that all of this AI is just a bubble. But looking at the market as a whole, the Shiller excess cyclically adjusted earnings yield is sitting at 1.1% right here. And this is viewed as largely unattractive. Looking at this data set, you would say that bonds are far more attractive than stocks. And this is similar earnings yield valuation measures that we saw right before the GFC, around the 1 to 2% range. Now, this doesn't mean we're headed for a crash, but it does suggest that we might be nearing a point where corporate earnings could slow down. If that happens, stock prices adjust accordingly, normally in the form of a pullback or a correction in time. This makes stocks more appealing as earnings recover. Now, analysts are hinting at the fact that we might be at a turning point in valuations. As you can see in the chart, all US sectors are expected to see thinner valuations over the next 12 months. If it's above this line, it means we're going to see lower valuations in the future. If it's below, we're going to see higher valuations in the future. And tech stocks leading the pack is set for a significant adjustment in the future. Same too here with healthcare. On the flip side, however, sectors like oil, gas, telecoms, and financials are the cheapest with smaller expected valuation drops. If energy doesn't appeal due to ESG concerns or outdated models, financials could be worth looking into, because looking at risk-adjusted returns, financials have actually outperformed tech stocks with above market Sharpe ratios, meaning their returns relative to volatility have been better over the last year. Optimism around US banks, especially after the SVB situation, came back strong in late 2023, and while regional banks are just starting to catch up, there's still more upside potential if the broader economy stays solid. And looking at the overall broad economy, this is very interesting. Goldman's GDP tracking estimate. Now, we do know that the Fed's GDP now is sitting at 2.1%. Goldman's currently sitting at 2.7%. Very, very interesting. So despite all of the data, they see GDP largely unchanged for the third quarter. And this is some very interesting data. Now, real GDP has clocked in at 2.8% annualized since the Fed amped up tightening 2 years ago, thanks to services spending as well as government spending. You can see government spending right here, as well as services spending. This has kept GDP quite robust. Non-residential fixed investment is normally good throughout the cycle, and then goods consumption has been a little bit of a laggard. Hopefully we see a return, but what's really held all of this back has actually been residential fixed investment, essentially the housing market, the real estate market. And despite a 5.5% annualized decline since 2022, we're still printing a 2.8% GDP figure. And as we get rate cuts, this opens up credit creation. Normally, when we do get rate cuts in soft landings, credit creation absolutely flies. That's going to open up that part of the economy. And this is also what's going to drive earnings in the broader economy, stuff like utilities, REITs, energy, financials. But it's all dependent on if people have jobs. Today's non-farms was simply not pretty. We clocked in at 142,000 or 146K. The market expectation was actually 166. We had names like Beaufort come out and say we were going to get 200K. They missed by a wide margin. We also saw the July numbers get revised down by about 25K from the 108,000 mark to the 89,000 mark. So very ugly non-farms data. However, we did see the unemployment rate tick down from 4.3 to 4.2%. And a highlight of the non-farms was actually that employment construction hit another new all-time high. Employed persons continue to make higher highs. And this is actually a really great barometer for the economy, something we look at every single non-farms just to determine the overall health of the jobs market. And construction employees continue to make a higher high. That is a bright spot, but in aggregate, it was a pretty terrible non-farm. And this is really adding to the camp for a 50 basis point cut in September and even November, possibly December. There is a possibility, if data continues to weaken, that we see a full 150 basis point worth of cuts through the end of 2024. But September, it's looking like 50 after this report. And then data next week. So we don't have much of anything on Monday. Then we got the NFIB Small Business Optimism Index on Tuesday. And Wednesday really kicks off with CPI. We get inflation data. Then the PPI figures the next day on Thursday, as well as initial jobless claims. And then the import price index on Friday, as well as some consumer sentiment measures. So we'll tackle all of those exact figures and what to expect in next week's video. And then in terms of earnings, guys, we're nearing the end of earnings season. The only big names on this list is Oracle right here on Monday, GameStop after the close on Tuesday, and Adobe on Thursday. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers. Welcome everybody to the daily.